Welcome to the stock play of the day. Today's stock is Uber. We will discuss, yes, should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst with
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest. Today, we're seeing green across the market here in the US anyway, despite the China market being down sharply, more than 7%, the Shanghai index today, on the back of all the coronavirus fears that have come out. There's hundreds of people that have died from this virus. Tens of thousands of people have been infected in China, and we have a few cases here also in the U.S. And it spooked markets on Friday. The S&P or the Dow Jones, excuse me, was down a sharp 600 points on Friday, but we're coming back to life today. But Brian, I think you have a chart of the S&P 500 up there now. We drew a trend line on that chart a couple weeks ago, and last week I think we broke right through it. Where do we stand now?
Yeah, the level last week that we actually mentioned was the 3250 level. And right now we actually have the market right around that level. It's actually at 3249. It's interesting. So when you break through a trend line like that, the support becomes resistance to the upside. So it'll be interesting going forward to see what type of channel that we form, because we've definitely broken that trend. And then also we see the VIX index is trading right around the 17, 18% level. And honestly, with a big down day like we had last week, obviously the VIX is coming roaring back, but we never did really get to the 25, 26 VIX level, which would mean that we're getting a little bit more complacency back and getting a little bit, like, in other words, we're the nervousness really, or the fear index really didn't get high relative to what we saw happen in markets like. So to me, that's just an interesting fact that we're back down around we got some volatility in the market, and it's going to be interesting going forward to see what type of channel the form now that we've broken through.
Yeah, it's definitely going to be interesting to watch because, I was a little surprised this morning to see how much the markets were up, especially after all the news that came out over the weekend. This coronavirus, you got Morgan Stanley out there saying that this could be a 1 percentage point hit to China GDP in the first quarter, and that would mean about a 0.4 of a percentage point impact to global GDP. So this is going to have a serious impact on growth around the world. Now, we do know from looking back at SARS and other viruses and epidemics that have hit the world, that usually these sort of situations are just temporary in nature, that they will impact one quarter of earnings or GDP growth, and then you'll see a rebound in the following quarters. So that should give investors some sort of relief, but in the near term, this is a very serious thing that will have an impact on GDP, not only in China, but across the globe too. Hopefully it doesn't spread much more, but it's something that we need to keep our eyes on, and it definitely can impact the market and could make that trend line that you drew a serious level of resistance. Also, on an economic front here this morning in the U.S., we got a little bit of mixed data too. I just wanted to point that out. The industrial ISM manufacturing data that came out this morning was much better than expected. Actually broke into expansionary territory again. The reading was right above 50 for the month of December. So that was very encouraging because we had this big bifurcation over the last 5 months between the industrial economy and the consumer, where the industrial manufacturing economy had been much weaker and had slid into contractionary territory while the consumer remained strong. We also got construction spending this morning. It actually declined slightly in the month of December, and so that was the first decline since June on that metric. So a little bit of mixed data, some good manufacturing data, a little bit weaker construction spending information, but we're also in the second busiest week of earnings too. We've got about 45% of the S&P 500 has already reported the fourth quarter numbers, and we're going to look for a big slew of companies reporting this week as well. Now, before I dig into our stock play of the day, I just want to remind our viewers that there is a box to your right where you could type out some questions for Brian and I that we're going to be taking at the end of the show. So make sure you do that. Anything that comes to your mind, feel free to type it in there. We love to hear from you guys.
So the chart of Uber is up.
Oh, all right. Yeah. So let's dig right into Uber. This one, it's so funny, Brian. Uber is turning into the darling of Wall Street again. Do you remember when it was, everyone hated it this summer? The stock, I think, was down about 40% from its IPO price not that long ago. But now we're looking at it on a year-to-date basis, and it's up more than 20%. What changed? Well, this morning, Wedbush added it to its, biggest convictions list. Last week, JP Morgan initiated coverage on Uber with an overweight. So Wall Street is getting bullish on the stock, but to me, not much has changed. You see the chart there. It's still off of its IPO price. This company went public in May after a lot of interest in the IPO. The valuation wasn't as strong as many had expected, but it went public at the price of $45. A lot of these analysts that are coming out with these bullish calls are pricing the stock, in the high 30s to $40 range, so not even quite getting to the IPO price. But I think people are a little more encouraged about the discipline that management seems to have. They just sold their India food business, food delivery business that wasn't doing so well. So they think that the new management team is really going to come in here and be able to streamline the business and get rid of areas that don't make a lot of sense. And Wall Street, actually, the consensus is for this company is going to return to profitability in 2021. We'll see if that happens. They've been EBITDA negative for several years now. And that would certainly be an encouraging sign if they did turn EBITDA positive. But I think that they do have a lot of fundamental issues to get through before they reach that level, and that will be a number that Wall Street watches very, very closely. And if there are any stumbles along the way getting to profitability, I do think that the stock will be negatively impacted. I think that there still is a lot of competition in this space in ride hailing. There's serious price competition that, there's reports out there that pricing is becoming more stabilized for these guys. But I think it's going to be, the consumer at the end of the day is the one that has to say on what the prices are. These companies like an Uber and a Lyft, they're both in the food delivery business too, which is, I think, also very price competitive. So there's a lot of things going on, and most of Wall Street really likes Uber for its longer term prospects, for when we get to automated cars and cars are just driving themselves around, and people won't be owning cars in the future. That's the prediction. And that very well could be, and Uber could be a formidable player in the autonomous car space. But I just don't see that for many years to come. So I think that it's going to be a very critical road by investors and by Wall Street as the next couple of years unfold. And that profitability number is going to be a very key metric that's watched. And like I said, if there's any hiccups along the way to profitability, the stock's going to pay the price. So this one just makes me a little bit nervous, especially given the run that we have seen in such a short period of time. We're only a little over a month into this year, and this stock is off to the races, up, like I said, more than 20%. And you're looking at an S&P that after Friday's close was in the red for the year. So without profitability, I think it's a tough call. But what are you seeing in the options there, Brian?
Well, yeah, and just even on the chart, we see that they had the big run up. Now we've pullback. Now it's kind of chopping. So in the options market, we got big news that's coming as far as option is concerned, in that we have earnings that are going to be in. Go to the Ally Invest option chains here. We see that the earnings date is going to be after the close. And so I think based off of what we're talking about here, I picked a pretty conservative earnings play because we're going into earnings. And as Lindsey is implying, earnings are going to, the path to profitability is going to be really important for this. Every earnings report, people are going to be, and if we do get some a little bit of a downward momentum after earnings, a lot of times that trend will continue. So I'm going to do a very simple strategy that's only centered around earnings right now. But some people might want to wait and see, and then we could move forward from there. But here's the trade that I'm going to look at today. We're going to do what's called a long call spread, or long put spread. This is also known as a bear put spread. We're hoping that after earnings, the stock will go down. Know that we have pumped up implied volatility because of that earnings going to be in. And so we're going to buy an option, we're going to sell an option at the same expiration. So in this instance, the stock is actually, we're going to buy an option contract that's a little bit in the money. We're going to sell an option contract that's a little bit out of the money. So if we look at the Ally Invest options playbook here, inside the playbook, we just have a generic strategy, but it's going to be somewhere between strikes 8. And our goal on this strategy, we're going to buy about the same amount of time premium as well. So we take that time premium piece, volatility piece, out of the picture by doing this strategy. So let's get to, if I go back to the option chain, I see the stock right now is up $1 going into this earnings week. And on the right-hand side of our chains, we have puts. Left-hand side, we have calls. And all that we have to do if we're looking to set up a trade here, we just click once on our checkbox so that we're going to buy, and then we'll click twice, and that means that we're to sell. So we're going to go out 11 days. This will encompass earnings and give us a little bit of a buffer, but we're taking the time premium out of it. So I don't mind going out beyond earnings. The actual expiration that would contain the earnings would be February 7th, which would be this Friday coming. So that would actually contain the earnings, and you could do that strategy. I prefer to give myself a little bit more time out. So we're going to go out to the 14th. We're going to have 11 days to that expiration date. And if I scroll down, here's what our trade is. And this is what I mean by taking time premium out. We're going to do a 2-point wide spread. That means that's the minimum that this thing can trade. Right? If I'm buying the 38 strike put and I'm selling the 36. And if I do that, that means the width of the spread is the maximum that that spread could trade for, and that's $2 in this. So we're doing it, and we're going to pay $1 for this trade overall. Right now, we see it trading at 96 cents. That's at the midpoint. I would, going into earnings, I would think that we could be somewhere near the midpoint, but it's never a guarantee. And as always, when we're looking at these strategies, they're not meant to be recommendations, just a paper trade. We're just trying to learn here on the stock play of the day. So paying $1, and we can make $1. So literally, it's just a 50-50 bet here in that, well, if we get this trade off for 96 cents, the maximum we can make is $1.04, and we'll pretty much know after earnings exactly what is expected of this underlying stock. So with that said, let's go on back, and I want to show you a little bit of a trick that I like to do when I'm looking at a put option. Now, if I'm buying something that's a little bit in the money here, the 38 strike, I see, if I look over on the left-hand side on the call side, I see that the bid and ask is about we'll call it $1.50, right? So that's the approximate amount of time premium that's in my in-the-money put option. Now, if I scroll down and I look at the put that I'm selling, well, obviously, all time premium. So I always kind of like, when I'm doing a strategy where I really want to make the risk 50-50, I like to look at, well, what's the call trading for as far as the time premium is concerned? It's not always an exact number. It's just a quick and dirty way to time premium. And then look at the put that I'm selling out of the money. And then I want those numbers to be fairly close. I know that if they're fairly close, about a 50-50 going into. going into this earnings. So literally, we're looking for a little bit of a downward move on the announcement of some type of, not hitting the numbers. We get that downward movement, then we're literally looking at paying $100, make $100. That's it. If the stock comes up and it moves against us in that position, well, we got our risk limited. Our limited risk is going to be net debit that we paid for the trade. So we're trying to use an option strategy that will take the time decay potential out of the picture, also take the implied volatility risk out of the picture. Now all we're focused on is what's going to happen. So if I scroll down and I look at the actual profit and loss graph inside the Ally Invest platform, we see here, this is where the stock is at. This 38 is the strike that we have bought. 36 is the strike that we have sold. And so after earnings, we're hoping the stock will go down below 36. And if it does, then we make our maximum and we should be able to close out our trade fairly quickly, because we actually just have 1 week after that earnings report for this option contract. We are wrong, market goes up. We have limited and known risk. You see this dotted line here? That means that whatever we pay for this trade, which right now at the midpoint is about 90 cents, that's going to be our maximum risk on the upside move. All right. So that's the strategy for the day, and I'm going to actually show the trade ticket, and then we're going to get to your questions. So just to review it here, this is the Ally Invest option trading ticket. This is the red ticket. We are buying the 38 strike put. We are selling the 36 strike put. This is meant to be a paper trade. The midpoint would be around, right now it's at 95 cents. So we would put a limit of 95 cents, and that's try to. All right, now let's get to some of your questions.
Hey, Brian.
Yeah.
Can I just jump in quick before you get to the questions? I wanted to correct myself. I made a misstatement earlier. JP Morgan's price target for Uber is actually $51, so it is above the IPO price. I just wanted to clarify, but go ahead and get to the questions.
That was definitely worth it. Thank you. Here we go. We got Jill from Huntersville, and Jill asks, a little nervous to go short into earnings. What might be a post-earnings? And I can understand that. There's a lot, the stock is very volatile, and around earnings it can be extremely volatile. That's fair, Jill. The fact that this is just a $37 stock, after earnings, we'll see implied volatilities come in. That's usually the norm. Implied volatilities start to rise going into earnings, and then that starts to come off after. And because of that, I would actually just look at buying a long put. If you wanted to wait for the earnings, see what happens here. You get that downward move that we're kind of hoping for. The next best thing to do is the option outright. No, nothing that we need to hide from it. We go out at least 30 days or more in time, depending exactly on what strike you're looking to buy. It would determine exactly how far out I'd want to go in. If I'm buying a more in-the-money option contract, I might go out 30. If I'm going a little bit out of the money, I might actually go shorter and maybe go 21 to we'll call it 20 to 25 days. Just go a little bit shorter time. I'm going to look out of the money. All right. Well, that's a great question. I got another good one here. Harry from Camden says, what might Google's ride do to?
All right. Yeah, that's a great question, actually. Google's rideshare, actually autonomous car driving business is called Wemo, and they are definitely going to be a formidable player in this space. Google has a ton of money, and they've been pouring it into this business unit, and I wouldn't be surprised to see Wemo being one of the key players, if not the key player, when autonomous driving really is here and in full service.
All right.
Well, to watch.
I don't see any more questions out there. So I guess let's get into the summary. Let's talk a little bit about the indexes. You?
Yeah, so I know we're seeing green here in the US today, but I would just really caution investors in this type of environment when there is going to be an impact from this coronavirus on the global GDP. Just to take caution right now, the market is still highly priced with a premium. The current forward PE of the S&P 500 is just under 19 times, so that is pretty rich compared to its historical average, which is closer to about 16 times. So it's something to watch, and it's okay to take a pause here. The market may take a little bit of a step lower, and like you said earlier, Brian, that trend line you drew, there is some serious resistance at that point.
Right. And with the VIX index, I'd like, I'd like to see the VIX get to about the 25 level or 26 before I really start thinking, oh, that's just a one-off thing. There's a lot of other factors along with it. But if I'm looking at the actual volatility, I don't really think you get capitulation up until VIX gets, and it's now trading. All right, so the stock, Uber.
Uber, yeah. Just kind of cautious going into earnings later this week. Everything's going to really hinge on the path to profitability for this company. So I just urge a little caution. The stock's up more than 20% going into earnings. It's definitely one to watch. It's an interesting stock. I think you could take either side of the story here. I just think in a near term perspective, it's a tough one to be in. I think it's a little bit richly valued here. And by the way, one of our producers of the show reached out. She's in Miami, and do you know how much an Uber cost in Miami last night?
Not.
It's $335. Talk about surge pricing. It's like in New York City when it rains, the prices go through the roof, but they're never that high. $335.
Wow. Well, that is definitely interesting. If I look at the actual Uber chart too to go with it, one of the things about the big run up and going into earnings, they might even have decent earnings and could be a time to sell. When you see markets go up about 20% going into an earnings like this, the news doesn't pour for this. That's why we decided to do something not too risky. Got defined risk. Doing a long put spread is very simple. Either make $1 on the trade or lose. All right, well, that's going to be it for the stock play of the day. All right, so make sure you hit subscribe and then ring the bell to make sure you get all the alerts for all the upcoming stock plays. Thanks for coming. Same time, same place next week.
See you next week.